For me, it's not really expect the unexpected. I think the thing for 2021 is still everything is on the table. We're still in a pandemic. We're still at risk. We're looking for potentially that double dip recession where we had some positive growth, but we may still be headed south just based on, everything that's out there with, things still being closed in some areas of the country and just a lot of risk out there. So I think the key is still focusing our operations, our businesses on survival. For me, that's developing a written plan, how we're going to make it through this year. Maintaining cash flow is just absolutely critical for us there. The other thing I'm kind of thinking about is in terms of U.S. consumer beef demand, it's remained strong throughout the pandemic thus far. We've lost over 110,000 restaurants in 2020. That's important. Those are restaurants that are no longer selling beef anymore. So those are definitely some considerations that we have to take into account. So we just got our January 2021 cattle inventory report, U.S. beef production cattle numbers. What we got in this report is it let us know that we are continuing on the path of tightening. So U.S. beef production is going to tighten as we move forward. So that's going to mean that, the Packers not going to have as much leverage. Cattle numbers are going to be declining. Basically for 2021, we're looking at a stabilization continuing from 2020, 2019, stabilization, and we're kind of moving into this declining phase. And that'll be really good for us if we look at for larger margins over the next 5 to 7 years. Cattle inventory numbers, they peaked in 2019 for this current U.S. cattle price cycle. Just a couple highlights here from the cattle inventory report. We know that U.S. cattle inventory for 2021, January 2021, 93.6 million head. U.S. cow, so that was 0.2% below a year ago. U.S. beef cow inventory, 31.2 million head, 0.6% below a year ago. Now, so you had U.S. cattle inventory and U.S. beef cattle inventory below, but you still actually had replacement heifers and replacement heifers that were exposed being just above a year ago levels. And that's kind of why we're saying, hey, we're in this stabilization for 2020, maybe even into 2021. But I think there's also some factors out there that might change things for us. So keys for us on this report: it did not produce any significant evidence that we have herd liquidation currently. That was really important. We were expecting that, but we didn't get that out of this report. Calf crop is down 1.3% from a year ago. While this is supportive indicator for our cattle prices moving forward, it's definitely going to help us in terms of that long-term market price trajectory as we look at the cow herd over the next 5, potentially out there to 7 years. Now, so there's the other thing. We got a calf crop down, but typically we've been having these carcass weights that are much heavier than what we've seen over the last several years. So how is that really going to play into effect? I'm assuming that some of these slaughter weights are now going to be declining due to these higher feed costs. So the smaller calf crop and lower levels of beef production in the future are going to be critical for us really to obtain those really significant higher prices moving forward. So here's the drought monitor. I just want to show you 2 looks at it. This is from September 29th, 2020. And here it is from this last week. So just the severity of this U.S. drought. There's been a lot of producers that they've been supplementing out there they've been supplementing and feeding hay throughout the last 12 to 15 months in some parts of the West out there. So it is absolutely critical that they either get rid of some head or get some adequate rainfalls. There's definitely going to be some liquidation out there in the West. Potentially, we think they held over some cattle due to CFAP 1.0 and 2.0. So we'll see how this plays out going forward, but we expect some liquidation from the West this year, especially if things don't get better very quickly out there. And then just throwing this in there just to give it a little thought, you still have March through May where we're still expecting it out there in the West, at least in the Southwest, to still be much hotter and much drier than normal. And then when you get into that May through July standpoint, it's just going to be hotter everywhere. That Southwest cools off, but that Northwest continues to be dry. So just looking at feeders and packers. So just looking at cattle on feed numbers, basically January 2021, this U.S. cattle inventory report, basically same as last year. So we're up 0.3%, not much change there, but at the same time, we're still at those elevated carcass weights. I expect that to change as we move forward, but still at that same number as last year, about the same number of cattle outside of feedlots. So whenever we think about feeder calf inventory that's right outside the feedlots, we're at the same level as we were last year. That follows the same trend in terms of stabilization. So in terms of where we are right now, live cattle, they need a little bit more than a seasonal price increase. And that's kind of going to be one of the themes that we talk about here. We got box beef prices. They've been steady. They're now rising. That is the seasonal. So as fed cattle prices, I mentioned they need a little bit more than the seasonal in terms to get back to break even for a lot of these feeders. Right now we've got packer margins that are comfortable. There's plenty of supply out there in terms of cattle still. The leverage was significantly shifted to them last March and April. So there's little reason right now for packers to bid up inventory. Supply is plentiful in terms of cattle that are available. Okay, so cattle feeders continue to bleed. My comment is that someone somewhere is getting tired of betting on the come. So right now we have a situation where cattle feeders are they're trying to get bigger, and they're willing to take on additional risk in order to make that happen. They've continued to bid up feeder calf prices above break-even levels since March of last year. So this is just on an annual average basis, but obviously you can see that there's a lot of downward risk in terms of being a cattle feeder. So why are they taking on more risk right now? We just mentioned those feeder cattle prices being significantly higher, but now we've got another variable here in terms of corn and other feedstuffs. What I said in black is what I said in October at the Southern Outlook Conference, and it is not so anymore. Things have changed dramatically in the last 3 months. Corn, it was relatively cheap. Now it's 74% higher. Grain sorghum is now 113% higher. Soybean meal is 53% higher, and DDGs are 93% higher. And this is these are prices. The DDGs we're looking at Memphis. The sorghum was looking at Southern Plains, and corn looking at Southern Plains cash prices for the corn and the sorghum. So just to give us some trajectories there in terms of these feedstuffs that are out there and available. Corn and other feedstuffs. This was a project delivered to Southwest Alabama. As you can see there, there's just significant increases in corn. Gin trash residues have stayed pretty steady over the last 3 months, while these feedstuffs have increased dramatically. You have whole cottonseed, soy hull pelleted, and corn gluten pelleted there. Just significant increases in terms of these byproduct feedstuffs. So it's very key and very important as we move forward, thinking about how that affects our operation. One of the things that we've got to be focused on is adding additional weight to our cattle. So, it's always important to make that comparison to this December feedlot cost of gain. And again, this is before we get into really moving some higher price corn through these animals. You're looking at steers, there's 78 cents a pound, heifers, 84 cents a pound. So moving forward now, every kernel that's consumed must now be replaced by something that is potentially 25, 50% higher in terms of corn compared to what it was potentially purchased at over the last 2 to 3 months now. So I got this from Daryl Peel yesterday. I was in a conference with him. He pulled this up on the screen, so I thought I'd throw it in there. We're moving from somewhere where you were in that, $3.50 range for corn dollars a bushel to where it would have a feedlot cost of gain of 73 cents to now you got feedlot cost of gains up there, approaching $1. So things have definitely changed. Things could, as we move forward, depending on that demand from China for corn, for their hog production, for their industry, we'll see where things go for us in terms of these corn prices. Now, typically it's said that high corn prices makes for low feeder calf prices. Well, the other thing to take from this is every additional pound that you gain, you're going to be able to acquire this, this higher value of gain based on the feedlots not willing to or be more willing to pay more for heavier weight feeder calves, heavier weight feeder cattle from us in the Southeast. So it may be rough on the feeder calf side, but it can be very, very popular for us on the backgrounding, preconditioning, or stockering side. If we're focused on forages, we're focused on minimal supplementation. So cattle feeders, they continue to bleed. So we've got high feed costs. We have high feeder cattle prices, and we've got low fat cattle prices. That just won't work. So one or more of these factors is going to have to change abruptly moving forward. The easiest way, just in my opinion, the easiest way for cattle feeders to fix this is to pay less for feeder cattle or feeder calves. So moving forward, that would be the easiest way to fix this. But they're bidding for these cattle. They're trying to get a little bit bigger, and the farmer feeders want to maintain the size that they are. So really, in terms of live cattle prices getting a little higher, the ball is going to be in the consumer's court. Consumer beef demand, is really going to be determined by packers bringing more inventory on grocery shelves. They're going to have to pay for it. They're going to have to bring more cattle, through the supply chain at higher or heavier weights. And that's just not how things are looking right now. So in order to get these live cattle prices higher in the near term, consumers are going to have to demand more beef at higher prices. Will consumers balk at higher prices? I think to some extent that they likely would, just based on our current fundamentals in the United States economy. So let's talk a little bit about where we are in terms of CME feeder cattle futures. The futures traders right now, whenever we're looking at these calves, these feeder cattle out here for the next 2-3 all the way out there to January, so almost 11 months now. There's some premium out there, so they're very bullish on the future feeder calf prices. That's very important. That gives us some optimism as we look forward to the spring and the summer months. Anytime there's a premium on the futures, I think we have to think about locking in that optimism. I don't think we should always anticipate the cash market to trade up to futures. Sometimes futures will erode the premium and trade down to the cash market price. So no matter which contract we look at right now, there's a premium compared to what feeder cattle and feeder calves are selling for today. So when I focus on the August feeder cattle futures price, and just whenever I'm looking at this August feeder cattle futures price, there's obviously going to be significant amounts of volatility. You can see there in the blue the volatility that we saw in 2020 that led to $250 to $275 a head change there during that March and April time period. And so could we expect the same level of volatility this year? Absolutely. there's still some unexpected events and obstacles out there for us to get through. So where are we right now? We're in that 150 range for the most part for these August feeder cattle futures, just a little bit positive, plus 150 right now. So what does that mean for us? Just looking at a basis of +3. This is for February 1st. That would put us in the range of 152, 153 for 550 pound feeder calves, kind of blended steers and heifers together here. So this would be a mixed load lot. Just based on that August 2021 feeder cattle futures price. I think, again, this is a solid price. The scenario moving forward is, kind of the status quo, that things stay kind of how they are now, not any more significant lockdowns. But that's just kind of what we're looking for and looking at today, is in that 150 range for these 550 pound number 1 and number 2 solid calves here, medium and large frame. So, one of the things that's out there that we really have to think about is that at some point we potentially have to plan for some inflation. The Federal Reserve's is now, they've said that with inflation persistently running below 2%, we will have to aim to achieve inflation moderately above 2% for some time, so that average inflation is 2%. So they're telling us that they're targeting and they're going to use monetary policy that's going to bring us inflation that's above 2%. Now, they've had this target for 2% for a long time. In some things, they're significantly higher than 2%. And then other things that they haven't been able to achieve their goal of 2%. So at some point, I think it's going to be critical. We don't have that significant inflation yet. Retail prices are moving higher because of added fees due to the pandemic. I don't call that inflation. Inflation is when, there is a increase in the velocity of the money supply, where it's moving at rates that are significantly higher than what we have today, where money is chasing products at higher rates. So at this point, I think it's just critical for us as producers and in the industry to consider these alternatives and what it would potentially mean for our business moving forward. So thinking about potential inflation and feed, right now, just the significant increase in demand and those feedlots are looking for alternatives, that demand coming from China, land rent becoming more expensive for assets, animal inventory, labor, and interest rates. So planning ahead is absolutely key for our bottom line. So if you're looking for some optimism, I think the future looks much better than the present. This is from the Food and Agricultural Policy Research Institute, FAPRI. And it just looks at potentially having that low out there in 2020, kind of what we've been looking for the last 5 years, and really moving out of that low into higher prices, out there in the next 5 to 7 years. I think things can be very optimistic, moving a little bit further out of this pandemic. And I think things can be very good for our cattle producers here in the Southeast. So I'll end with this. There's a light at the end of the tunnel. We need to consider that light at the end of the tunnel could be an exit, or it could be a train headed right for us. Definitely, the train hit us last year in March and April. I think we're still at a part where anything is possible. Just with all the extreme volatility that's potentially out there that we see in markets on a daily basis. The pandemic is nowhere near over. We're going to do the best we can, but everything is on the table. Use risk management when we can, but there's optimism out there in the future. So that's also an exit in a bright light.